Okay, so you want to own a cell tower, a steel pole standing in a field somewhere, quietly collecting a rent check from a phone company every single month, while you do absolutely nothing. No customers walking through a door, no inventory that spoils, no employees to manage. Just a fixed asset and a signed contract. That's the pitch, and on the surface it sounds like the closest thing to free money in all of real estate. Here's the problem. You are looking at the pole. The pole is almost the least important part of this business. What you are actually buying, if you buy it correctly, is a piece of real estate wearing a steel costume, and the entire industry is built around a single idea. Get as many strangers as possible to hang their equipment on the same fixed piece of land, because the tower itself is nearly disposable compared to what sits underneath it. Understanding that difference explains why this became one of the most quietly profitable asset classes in American infrastructure. And it also explains how a business that looks recession-proof can be gutted overnight when the wrong customer decides to leave. Let's start with what it actually costs to put a tower in the ground, because the number surprises people in both directions. According to figures the major public tower companies have disclosed themselves, a typical non-broadcast tower in the United States costs somewhere between $150,000 and $300,000 to build. American Tower, the largest tower operator in the world, has put its own domestic build cost at $250,000 to $300,000 per site. Crown Castle, the second largest, has cited a similar range of $200,000 to $250,000. That money buys a galvanized steel structure anywhere from 100 to 400 feet tall, sitting on a poured concrete foundation, surrounded by a fenced equipment compound with a shelter, a generator for backup power, and site lighting. It sounds like a lot of money for a metal pole, until you compare it to the alternative. A broadcast tower, the kind built to support television or radio transmission equipment, can run anywhere from $300,000 on an elevated site up to $3.5 million on flat terrain, because the structural loads are so much higher. Next to that, a $250,000 wireless tower looks almost cheap. But the tower is not the expensive part of the business model. The expensive part is the paperwork that has to happen before the concrete gets poured. A carrier or tower company has to identify a coverage gap, negotiate a ground lease or purchase with a landowner, survive local zoning review, satisfy environmental and aviation clearances if the tower is tall enough, and often fight a neighborhood association that doesn't want a 200-foot pole visible from anyone's backyard. In jurisdictions with strict permitting requirements, that approval process alone can take longer than the construction, and it can kill a project entirely before a single shovel goes into the ground. This is the first hidden truth of the tower business. The hard part isn't building the thing. It's getting permission to build it in the one specific location where the network actually needs it. That need for a specific location is what gives the whole industry its leverage. A cell tower is not like a retail store, where a slightly worse block still works fine. Wireless coverage is an engineering problem. A carrier has a gap in its network, usually a few square miles wide, and there may be only one or two parcels inside that gap that are physically buildable, properly zoned, and available to lease. That narrow window is why landowners can extract real money for a few thousand square feet of otherwise unremarkable dirt. A land parcel under a tower is typically only 2,500 to 3,000 square feet, smaller than most suburban house lots, and yet it can be worth more in monthly income than the surrounding farmland produces in a year. So what does that monthly income actually look like for the person who owns the land underneath? This is where the range gets almost comically wide, and the width itself tells you something important. Rural ground leases can start as low as $500 to $1,500 a month. Suburban macro towers tend to land somewhere between $1,200 and $2,800 a month. Urban rooftop sites, where space is scarce and demand is dense, can command $2,500 to $6,000 a month. And in the most competitive markets, offers have reportedly gone north of $10,000. Two towers sitting only a few blocks apart, on paper almost identical, can pay wildly different rents, because the price isn't set by the size of the parcel. It's set by how badly a carrier needs that exact spot to close a coverage gap, and by how many other buildable options exist nearby. A landowner in a dense city with no other viable rooftop for a mile in any direction is sitting on leverage. A landowner in open country with 3 other buildable parcels down the road is not. Now here's the detail that quietly changes everything about who actually makes money in this business. Most cell towers are not owned by the wireless carriers who use them. Verizon, AT&T, and T-Mobile do not want to be in the business of pouring concrete, maintaining steel structures, and negotiating with individual landowners across tens of thousands of parcels. That is not their core competency, and it ties up an enormous amount of capital for a very low return. Instead, the industry has consolidated around independent tower companies, structured as real estate investment trusts, the same kind of legal entity used to own malls or apartment buildings. American Tower operates close to 150,000 communication sites worldwide. Crown Castle owns roughly 40,000 towers concentrated entirely within the United States. These companies buy or build the tower, then lease space on it to one carrier, and ideally, several. That word, several, is the entire business model in a single sentence. A wireless carrier by itself is not a particularly profitable tenant for a tower owner. Industry analysis on this is unusually blunt about it. A tower with exactly one tenant generates a return on invested capital of only around 3%. That's barely better than a savings account on an asset that cost $250,000 to build and requires ongoing maintenance, insurance, and property tax. Add a second tenant to the same tower, and the return jumps to roughly 13%. Add a third, and it climbs past 24%. The physical structure barely changes. You're not building a new tower. You're not buying new land. You're bolting a second carrier's antennas onto steel that's already standing there. The incremental cost of that second or third tenant is minimal, while the incremental revenue is close to the full lease rate. That is why the major tower companies report gross margins on additional tenants north of 95%. This is the hidden mechanism underneath the whole industry. The first customer on a tower barely covers the cost of building it. The second and third customers are almost pure profit. A cell tower, in other words, doesn't behave like a piece of infrastructure. It behaves like an apartment building where the first tenant pays the mortgage and every tenant after that goes straight into the landlord's pocket. Which raises an obvious question. If adding tenants is this profitable, why doesn't every tower have 3 or 4 carriers on it immediately? The answer is that towers fill up slowly, and that slowness is actually part of the economics. According to one of the major public tower operators, a new tenant gets added to the average existing tower only about once every 10 years. That sounds sluggish, but it means the older a tower gets, the more valuable it becomes, because time is the mechanism by which single-tenant towers evolve into multi-tenant towers. A tower built 20 years ago has had 2 full decades to accumulate additional carriers, additional equipment upgrades, and additional 5G overlays, each one adding revenue at almost no additional cost. The industry's average sits at somewhere under 2 tenants per tower globally, which means there is enormous room left to fill. And the companies that already own the steel are sitting on assets that get more profitable simply by aging in place. Here's where the lease itself becomes the real asset, more so than the tower. These agreements are not short-term arrangements. Most cell tower ground leases run 25 to 30 years once renewal options are included, with built-in annual rent escalators, typically in the 2 to 3% range. Once a carrier signs a master lease agreement with a tower company, that contract can cover thousands of individual sites at once, locking in a predictable, growing revenue stream for decades without the tower owner lifting a finger. Verizon alone entered into a 10-year, over $5 billion sale and leaseback agreement with American Tower, covering more than 11,000 individual sites. That single contract is worth more than most public companies. And once that lease is signed, the landowner underneath it, whether that's an individual farmer or the tower company itself, is locked into rent terms that can run for a generation. That length cuts both ways, and this is the detail that catches inexperienced landowners off guard. A small difference in the escalator clause, the annual percentage by which rent increases, compounds enormously over 3 decades. Analysts who track these contracts have pointed out that when average rent escalators softened from around 3% down to roughly 2% industry-wide, that seemingly tiny gap could cost an individual landowner more than $200,000 in lost rent over the full life of a 30-year agreement. Nobody signing the lease in year 1 feels that difference. It shows up only when you run the math forward to year 30, by which point the contract can no longer be renegotiated. There's a second trap buried in these leases that's just as easy to miss on signing day. Many agreements include co-location language that determines whether the original landowner shares in the revenue when a second or third carrier joins the same tower later. If that clause isn't negotiated properly up front, the landowner who leased their land for the very first tenant may see none of the additional income when the tower company adds a second and third carrier years later, even though we just established that those additional tenants are where almost all the profit actually lives. The person who signs the original lease is, in effect, deciding today whether they'll participate in the most profitable part of this business or watch it happen on their own land without them. So far, this sounds like a business with almost no downside. Fixed structure, 30-year contracts, built-in rent increases, and a mechanism where profitability only improves with age. Now here's the counterintuitive part, the one that explains why an industry this stable can still be shaken to its foundation. The tower owner's biggest customers are not thousands of small businesses. They are 3 or 4 giant wireless carriers. American Tower discloses that T-Mobile, AT&T, and Verizon together represent well over 40% of its revenue. Crown Castle is far more concentrated. T-Mobile, AT&T, and Verizon collectively account for roughly 90% of its site rental revenue. That means a tower company that looks diversified because it owns tens of thousands of individual physical sites is, in reality, dependent on the decisions of a tiny handful of corporate customers. The apparent diversification of thousands of towers is hiding a real concentration in just a few tenants. A healthy-looking portfolio metric, tower count, disguises a fragile underlying customer base. That fragility became painfully visible when 2 of those handful of customers decided to merge. When T-Mobile and Sprint combined their networks starting in 2020, the entire logic of the merger was built around eliminating duplicate infrastructure. The 2 companies operated a combined 110,000 towers between them. Their stated plan was to decommission roughly 35,000 of those towers, the ones where their networks physically overlapped, while building perhaps 10,000 new ones, netting out to a smaller combined footprint. Every one of those 35,000 decommissioned sites represented a lease that was going to end. For an individual landowner, that meant a rent check that had been arriving every month for years would simply stop. For the tower companies, credit rating agencies flagged the merger as credit negative, specifically because it meant fewer lease renewals and reduced organic growth across the sector. Crown Castle was identified by analysts as the most exposed of the major tower companies to this single event, because Sprint and T-Mobile together represented a larger share of its revenue than they did for its competitors. In one disclosure, Crown Castle noted that on towers where both Sprint and T-Mobile equipment coexisted, those 2 carriers alone represented a meaningful single-digit percentage of its total site rental revenue, concentrated precisely in the overlap the merger was designed to eliminate. By the time T-Mobile finished integrating the Sprint network in 2022, American Tower reported that the resulting decommissioning activity had reduced its own organic tenant billings growth in the US and Canada by a measurable 4 percentage points in a single year. That is the domino effect in action. One merger between 2 of a tower company's 3 or 4 major customers rippled directly into the growth numbers of every tower operator holding leases with either of them. years after the deal was first announced. This is the volatility hiding underneath the apparent stability of 30-year contracts. The lease terms are long, but they are not permanent, and nearly every one of them contains language allowing the tenant to walk away if the site is no longer needed. Every cell tower lease, in practice, is written to favor the carrier's ability to exit, not the landowner's certainty of income. A tower can generate reliable rent for 15 years, and then, following a single corporate decision made in a boardroom that has nothing to do with the tower itself, receive a decommissioning notice and stop paying entirely. If you want to see what happens when this risk compounds across an entire company rather than a single lease, you don't have to look far. Crown Castle spent years pursuing a strategy that looked, on paper, like smart diversification. Rather than being purely a tower company, it spent billions of dollars acquiring fiber networks, including a $7.1 billion purchase of a company called Light Tower in 2017, with the goal of also owning the backhaul infrastructure behind small cells, the miniature wireless nodes mounted on light poles and rooftops that are supposed to densify networks for 5G. The pitch was that fiber and small cells would open up an entirely new growth engine beyond traditional towers. It didn't play out that way. By late 2023, the activist investment firm Elliott Management, which had built a roughly $1 billion stake in Crown Castle, argued publicly that the company's expansion into fiber had actually destroyed shareholder value rather than created it, because the returns on that fiber investment never came close to matching what the company earned from ordinary tower co-location. Elliott pushed for sweeping changes, including a full strategic review of the fiber and small cell business, which is Wall Street's polite phrase for exploring a sale. The pressure didn't stop with one campaign. Over the following 2 years, Crown Castle's CEO stepped down following Elliott's calls for his removal. His eventual successor was terminated after less than a year in the job, and the company cycled through an interim CEO before finally installing new leadership in late 2025. The turning point came in March of 2026, when Crown Castle agreed to sell its entire fiber and small cell operation, split between 2 separate buyers, for a combined $8.5 billion. Roughly $7 billion of those proceeds are being used to pay down debt, with the remainder allocated to share buybacks. What emerged on the other side was a company that had gone all the way back to where it started, a pure-play tower operator with about 40,000 sites and nothing else, deriving something like 90% of its revenue from just 3 carriers. Years of capital, a diversification thesis, and multiple executive careers were spent proving something the industry's own math had suggested from the beginning, that co-location on existing steel produces returns that a brand new business line, built from scratch in an adjacent market, could not match. The tower business didn't fail. The attempt to escape being just a tower business is what failed. Crown Castle's chief rival took a different escape route, and it's worth noting because it shows the same underlying anxiety playing out in a less painful way. American Tower, rather than chasing fiber, spent $10.4 billion acquiring a data center company called CoreSite in 2021, moving into carrier-neutral facilities that serve cloud computing and AI infrastructure customers rather than wireless carriers. That business is reportedly growing at a healthy clip, and the company frames it explicitly as a way to reduce its dependence on the small handful of wireless carriers that dominate its traditional tower revenue. Whether that bet ultimately proves wiser than Crown Castle's fiber experiment remains to be seen, but the instinct behind it is identical. Even the most dominant company in this industry does not want its entire fortune resting on the renewal decisions of 3 or 4 telephone companies. There's one more layer of risk sitting underneath all of this that has nothing to do with carriers at all, and it's the same one that has rattled real estate investment trusts across the entire economy. Tower companies are financed heavily with debt, because building tens of thousands of towers requires more capital than equity investors alone typically provide. When interest rates rise, the cost of refinancing that debt rises with it, which is part of why American Tower's stock traded meaningfully below its own multi-year highs, even while the underlying tower business kept generating steady, growing cash flow. A business can have a perfectly healthy net interest margin, so to speak, on its leases, and still see its value compressed because the debt sitting underneath the whole structure got more expensive to carry. The towers didn't change. The cost of owning them did. So does owning a cell tower actually work as a business? And for whom? The honest answer depends entirely on which side of the lease you're sitting on. If you are the individual landowner who leased a few thousand square feet of land to a carrier or tower company decades ago, on reasonable terms with a fair escalator and a share of future co-location revenue, this can be one of the most attractively passive income streams available to an ordinary landowner. Minimal effort, a rent check every month, and a payment that grows automatically for 30 years. If you are that same landowner, but signed an early, poorly structured lease with no escalator and no co-location clause, you may be sitting on a property that a much larger tenant is quietly profiting from every time a second or third carrier gets added, without you ever seeing a dollar of that additional income. If you are the company that owns the tower itself, the optimistic outcome looks like American Tower's core business, a portfolio that ages into ever higher returns as tenants accumulate, insulated somewhat by geographic diversification across dozens of countries, and increasingly supplemented by adjacent infrastructure like data centers that reduce dependence on any single wireless carrier's decisions. The realistic negative outcome looks like Crown Castle's fiber detour, years of capital committed to a growth story that never delivered the returns of the boring core business, ending in an activist campaign, multiple CEO departures, and an eventual retreat back to exactly the model it started with, just with several $billion and a half-decade less runway than before. What ties both of these outcomes together is the same lesson. A cell tower looks like a piece of hardware standing alone in a field, quietly doing its job regardless of what's happening in the wider economy. It isn't. It's a leasing business wearing a steel costume, and the steel itself is close to the cheapest, most replaceable part of the arrangement. The real asset is the contract, the location, and the ability to convince a second and third tenant to climb the same pole. When that works, it is one of the highest margin businesses in American real estate. When the tenants merge, consolidate, or simply decide they don't need that particular gap in coverage filled anymore, the pole is still standing there exactly as before. It's the income underneath it that quietly disappears.